Hello everyone once again, and thank you for taking that time out of your Thursday evening to join us. Welcome, my name is Primo and I am the president and founder of SpecialistTrading.com. And for those of you who are unfamiliar with our website, we feel we are your premier online source for education and learning how to trade virtually all of the markets, from everything from the Forex markets to the stock market to the Emini market, which we're going to talk about today. Just to give you a little bit of background about myself, as I said, my name is Primo, and I have been trading the markets, virtually all of these markets, going in and out of them roughly for the past 36 years. I started my trading career on the floor of the Pacific Stock Exchange. I was on the floor for a total of 16 years, and 9 of those years I was a specialist for Donaldson, Lufkin, and Genret. I traded through just about every market environment imaginable. I've traded through the crash, as many of you may well know. I have also traded through a great bull market that ensued after that. I left the floor in the mid-90s to manage money and to pursue my own trading. And roughly about 3 to 4 years ago, I started specialist trading, which just really incorporates all of the techniques and methods that I personally use myself. So everything I teach and everything that I use myself is coming from the floor. As you see here, these are the insights, wisdoms, and trading strategies from the floor. Now, what we're going to be talking about today is strategy number 7. This is probably our premier E-mini trading strategy for those of you who like to trade the E-mini or anything that is related to the market, such as the ETFs revolving around the S&P, such as the spiders or the diamonds. And we're going to show you the performance review for 2013 using this strategy, strategy number 7. And really, it's just the first 2 months. We're going to show you how well this has performed going back just the 2 months, and how well we performed actually in the last 2 years in which we've started generating and sending signals to our members. But before we begin today's presentation, I ask that you please take a moment to view our disclaimer. We're required to show you this, so I ask you to take a moment. I'm going to show you a lot of performance results using strategy number 7 and some of the components that make up this particular strategy. But please remember that we can in no way guarantee that any of these results will be repeated in the future. So please take a moment to view our disclaimer, and then we shall begin today's presentation. And as you're taking a look at our disclaimer, I'd also like to mention that please wait to answer, or wait to have any questions to the very end of the presentation. I'll answer each and every one of them, but I'd like to wait possibly to the last 10 or 15 minutes to answer any questions you may have. So it seems to flow, the webinar seems to flow a lot smoother if we just wait. So I know a lot of you may come up with a question during the course of this short but brief webinar, but don't worry, we're going to get to everything, and then finally at the end I'll answer anything you may have. If you happen to come up with a question once we've concluded, let's say you're looking at some of the tools I've given you to use, and then you have a question how to use it or how it works, you can call us or email us, which I'll give you all of that information at the end of the presentation as well. Okay? So there are lots of different ways to contact us. Please just wait till the end to ask any questions at all. So why don't we begin? Now, I'd like to begin with just starting out with the facts, and I want to show you these facts here, which has to do not only with E-mini trading or any type of strategy, but with all trading, whether you're an intraday trader, an investor, whether you trade the Forex markets, the E-mini markets, or the stock markets. And the facts are that 80% of all traders will ultimately lose money. And when I say 80% will lose their money, I don't mean you'll go into some type of drawdown. I mean that basically this 80% loses everything that they set aside actually for trading. The facts are that 15% of all traders will just break even. Now that's actually pretty good in today's markets, but after all your hard work and everything you've studied and all the different things you've read and tried to learn about trading, you're really going to have nothing to show for all your hard work. And what this means is that 5%, only 5% of all traders will be consistently profitable. Okay? That's it. So if there were 100 people in today's presentation, this means only 5 of you will be consistently profitable. Now, if you want to see what this looks like on a chart here, on a pie chart, we see here that this large circle, this large portion in red signifies the percentage of traders that will ultimately fail. This slice here in blue represents percentage of traders that will just break even, and this very small sliver here in green represents a percentage of traders that will ultimately be profitable. Now, I don't start off the presentation to scare you or to dissuade you from trading. I don't want to do that, and that's not the purpose of this, but just really to ask the question, we have to really ponder, like, how is it possible that the majority of all trading profits are captured by such a small percentage of traders? You know, I really feel that the majority, or I should say that all trading profits, the market is like a big pie in the sky, enough for everyone to take. It's really unfathomable how much profits anyone can take out in a given day. It's like going to the ocean and taking out as much water as you want. It's never ending. But why is it that only such a small amount is able to continually take out some of those profits? Well, at Specialist Trading, we know the answer. It's actually very simple. These traders have an edge. Whether they know it or not, they're either doing something or not doing something that the majority of all other traders are doing, which fits into that 95% group where they're actually not making any profits. But we have to ask ourselves, what type of an edge do these traders have? I mean, everyone thinks they have an edge, right? If you're trading, you feel you must have some type of an edge, something that is going to get you on that road to success. Well, let me start out by sharing with you what I learned about edges on the floor of the exchange. When I first started out, I thought I had edges just like everyone else. In fact, I had 2 or 3 working trading strategies. I had tons of indicators on my screens. I was involved with tons of news broadcasts where I was discerning every bit of news and every type of information that was coming out at the moment. And still I struggled for my first year or two as a specialist. In fact, I really couldn't make ends meet. I thought there wasn't going to be much time longer for me to begin a specialist because while everyone was being profitable, I had a difficult time making ends meet. It was kind of like riding high in April, shot down in May. I would have 8 or 9 great trades or great months, in fact, and then I'd lose it all in 1 month. So I know that this may speak to a lot of you. You may be going through this yourself, so I know how you feel. It wasn't until I came in contact with a few mentors who really turned my way of trading around by telling me what I should be looking for in an edge. And this is what they described to me. They said, Steve, an edge is something that sustains you. Okay, now what do we mean by sustain? Well, in other words, you want something, whether it's an indicator or a strategy, that is going to sustain you throughout every market environment or condition. Okay, too many traders rely on an edge that just works one way when the market is either going up or when the market is really strongly trending. But when it goes into another environment, into another type of condition, it doesn't work anymore. It ceases to work, right? I'm sure a lot of you have gone through this where something works great and then it just stops working. Well, this is not a real edge in our opinion. An edge is something that's going to sustain you no matter what the market environment is. It's going to sustain you no matter what the conditions are. So that's one of the components of an edge. They also taught me that an edge is something that you can rely on. So what do we mean by rely? Well, another way we can say it is an edge is something that you can trust when you're going through some tough times. Because every edge, every strategy, every indicator, every tool will go through some type of drawdown phase. In other words, a slump where it's not performing very well. This is totally natural. Our strategies go into small type of drawdowns where we're not doing that well, but they're small and minimal, and then they bounce back and get back in sync. So you have to trust it and rely on it. Now, if it goes into a sustained drawdown, where it goes for months, if not years, where it doesn't produce anything, well, that's not a real edge, okay? But lastly, most importantly, what my mentors taught me is they said, Steve, an edge is consistent. So what do we mean by consistent? Meaning that however it performs, it should be looking to hit singles and not home runs. Because anything that is just geared towards making home runs, making tons of money, can just as easily lose that. I know tons of traders who made hundreds of thousands, if not millions of dollars on the floor and then quickly lost it. So their edge was having something that was able to really make a lot of money really quickly. But the same edge lost it for them very quickly. So that's not a real foundation for an edge. We want something that will just go to make these small, consistent gains. So that's what a true edge is, something that will sustain you, you can rely on, and that is consistent, that will work 10, 20, 30 years down the road. So this is what we're looking for in any type of an edge. So ask yourself, whatever you're using to trade, does it have these components as far as an edge is? If you've gone into these sustained drawdowns, or if it only works in one type of condition, or if it makes these great trades and then loses it all, this is not a real true edge, okay? All right, so here's what you're going to learn today. Now that we described and kind of shown a little bit of my history, what I had to go through to get on that road to consistency, I'm going to share with you 2 of the edges that make up the foundation of one of our best E-mini strategies. The first edge is called our buy-sell line, and it's basically a great tool to get you on the right side of the market. Too many traders, regardless of your investing or intraday trading, lose because they're on the wrong side of the market. They should be buying when they should be selling, and vice versa. So we're going to show you how to use this great number 1 edge. And then the second edge is our confirmation method, which is really a fine-tuning technique. So once you know what side to be on, you'll fine-tune your entries. Okay, and then we're going to show you how these two edges make up probably our most resilient E-mini strategy, and that's strategy number 7. But remember, it's not just for E-mini traders. You can also apply it to EDFs, and if you'd like to apply options to it for any type of a market type of instrument, you can do that as well. And then, as I stated at the beginning, if you have any questions, please write them down and try to remember them, and then I'll answer them in the last 10 or 15 minutes. So this won't take long. We'll go through these in detail, but then we'll answer any questions that you may have. All right, so why don't we begin? Let's start out with our first edge. As I stated, this is our buy-sell line. It is probably the most powerful tool we have at Specialist Trading. We incorporate it in virtually every strategy, every technique we have. But it's extremely, extremely simple. And what it is the 50-period simple moving average. Okay, that's all it is. But how do we use this? How are we going to apply this particular edge? Well, we want to just chart on any charting instrument we're looking at, regardless if it's the E-mini, the Forex, or the stock market. We want to plot a 50-period simple moving average. Okay, it doesn't matter what time frame, it doesn't matter what direction we're interested in looking. But once we plot a 50-period simple moving average, in order to use this correctly, we're going to ask ourselves, where is price in relation to that 50-period simple moving average or the buy-sell line? Okay, I'll say that again. You may want to write this down. Where is price in relation to the 50-period simple moving average or the buy and sell line? All right, that's what you must ask yourself, that question, before you enter a trade. I don't care if someone told you that something, it's a sure bet, it's going straight up or straight down. Before you pull the trigger, ask yourselves, where is price in relation to the buy-sell line? And then you'll only come up with two possible scenarios, because if price is above, you should only be looking to buy. In other words, you should be looking for buy scenarios or buy setups. And if price is below, then you'll only be looking for sell scenarios or selling setups. And that's it. You can't do vice versa. Now, I know a lot of you would say, well, that's too simple. What's so big about this edge, or how powerful can this be? Well, one of the ways we measure and see how important a buy-sell line is by going back in different time frames and in different directions. So let's go back to that time period when a lot of people lost a lot of money, and that was in the beginning of the recession in 2008. Now, we all remember that the market had been doing very well up until then, and then it just fell out of bed. A lot of people lost a lot of money. A lot of companies went under, in fact, and a lot of people lost everything, actually, from 2008 on. What if there was some type of tool, some type of indicator that could have helped us, at the very least kept us out of that terrible scenario that began in 2008? Well, here's a weekly chart of the E-mini going back to January of 2008, actually before that, December of 2007. And we've plotted the buy-sell line, the 50-period simple moving average, and we ask ourselves, in January of 2008, where was price in relation to the buy-sell line? Now, obviously, we had some consecutive closes below here as far back as December and even in November. So we were already alerted that the market was not looking too favorable. So we could have done a number of things. If we were currently long, we could have either exited altogether if we wanted to be that aggressive, or we could have exited a portion of our position, or at the very least we could have moved our stop up, maybe up to unchanged, so we could at least protect ourselves, or even higher to protect some of our profits. Now, if you wanted to be a more aggressive trader, you could have exited all your position and then started to look to go short. And I'm sure you would have done very well the way a number of our members did, and the way a number of people I know that use this particular technique, myself included, because you weren't long anything from 2008 going all the way down, okay? Now, what if you say, well, Steve, I don't trade daily bars. I'm not an investor. I like to day trade. In fact, I'm in and out in 5-10 minutes. I look at a 5-minute chart. How can this possibly help me? All right, well, let's go back in time again. Let's go back about 3 years to a little thing that was called the flash crash. Remember that? A lot of traders were complaining. They said, Steve, how can you make any money? I know you have all these techniques from the floor, but there's no way we can make money against the big boys that have all these programs and all these high-speed trading techniques where a little guy who has a $10,000 or $20,000 account can't get in the way of that, and there's no way we can make any money. Well, let's use the same technique again. Let's look at a 5-minute chart during the flash crash. All right? We plot a 5-minute chart of the E-mini and we ask ourselves, where is price in relation to the buy-sell line? And just for a couple of intermittent bars here at the very beginning of the day that were above, that went up above and then back below, the majority of the day, 99.9% of the day, price was below the buy-sell line. So what does this tell you? It tells you that you shouldn't have been long at all. You should have only been looking to go short if you're an intraday trader during the flash crash, trading a 5-minute time frame. Okay? So there's no way you really could have lost money that day because you should have been looking for some nice shorting setups. The only way you really would have lost a lot of money would have been if you were trying to pick bottoms, which we strongly go against in specialist trading, and you're trying to pick a bottom in a downward move. So there's no way we would have lost any money, and some of our traders had some of the best days ever during the flash crash. Now, just to show you that this doesn't just apply towards the E-mini and toward markets, it also applies for other markets such as the Forex and the stock market, and it also does very well in the face of news. Okay, I know a lot of people will say, well, Steve, you know, many times a news item will come out and this really won't help me. Well, that's true. Sometimes it won't, but the majority of times it will. In fact, the majority of times the buy-sell line will help you ahead of a news announcement. Let's look back in about a year ago, in May of 2011, or a little over a year ago, I should say. No, actually a year ago, I'm sorry. The headline read, JP Morgan suffers a big loss. JP Morgan Chase, in a surprise announcement, said Thursday that it had suffered trading losses of $2 billion since the start of April. Now, the group that suffered the losses is part of the bank's so-called corporate unit and had been making trades designed, of all things, to hedge against risk. Shares of JP Morgan, JPM, fell 9% in early trading on Friday. So this is terrible news. If you were an investor, if you held on long positions in your portfolio with JP Morgan, you would have had a rough opening that day because, as we see, JP Morgan had been in a steady downtrend, but the day the news came out, well, you had a decision to make if you were long. You could have either sold on that day when the stock opened down 9%, or you could have held on and said, well, you know what, I'm going to hold on for the long run. Maybe I'll buy some more. And that probably wouldn't have worked out too well because you see it went down even lower in the weeks to follow. So how could the buy-sell line have helped us? Well, once again, always plot the buy-sell line regardless of what market or what time frame you're trading. We simply plot the 50-period simple moving average, and we see as far back as a week or two prior to that announcement, we had consecutive closes below the buy-sell line, giving you a clue that you should no longer be in JP Morgan. You could have exited a full 5 or 6 points higher and gotten out of your position, and you wouldn't have had to ride it all the way down to $30, $31. Now, if we look and we said, well, Steve, but I wanted to get back in. How would I know to get back in? Well, if we look at a larger picture of JP Morgan going into months to follow, we see that the stock bottomed out roughly about 31, bounced up a little bit, kind of hovered, and then in August of 2012, here's where we had a nice area to go long because we had consistent closes above the buy-sell line, where it has been ever since. So you could have exited the stock somewhere around these levels and then gotten back in somewhere around these levels. Okay? That's how easy this technique is. And it'll really save you a lot of money, and it'll really get you on the right side, more importantly. Now, lastly, let's look at probably the best scenario for using this. Let's look at the granddaddy of them all. This was the crash of 1987. I was on the floor during the crash, and this was just an amazing time to be trading on the actual floor, tumultuous time, but something I'll never forget. This was on October 19th, 1987, and the Dow fell a total of 508 points that day, or roughly about 22%. Now, 508 points by today's standards is really not a lot. We've seen that happen, and you know, you can still come out unscathed after a day like that. But if we really wanted to meet it to today's standards in relation to how it would look today, well, proportionally 22% would come out to roughly nearly 3,000 points. So you can imagine how your portfolio or how your trading would look if the market were down 3,000 points in one day. So how could this tool have helped us? If we were an investor or if we were trading, how could the buy-sell line have helped us? There's no way it could have steered us clear of a major crash, such as the crash of 1987, right? Well, let's plot the buy-sell line. And as you can see, as far back as 3 weeks earlier, we had consecutive closes below the buy-sell line. So if you're an investor in your portfolio, you could have exited at the very beginning of October before the market fell out of bed. And you could have stayed out of all the ruckus until it finally turned around and went back above the buy-sell line. So this is the beauty of this tool. It works in any market, in any time frame, and in any direction. All right, so now that we know which side to be on, okay, this is our buy-sell line. We know which side to be on. We know that we should only be looking for long scenarios if we're above the buy-sell line. We should only be looking for shorting scenarios if we're below. Now, how are we going to fine-tune our entries? Once we have a strategy that is in sync with the trend, how do we fine-tune our entry to give us an even higher probability for a winning trade? Well, here's our confirmation method, okay? This is, once again, a great, great tool. It's probably the second most powerful tool we have at Specialist Trading. It's a fine-tuning tool, and the reason why we say fine-tuning is because so many traders rely on outside sources to tell them when to enter into a trade. And we feel that's really counterproductive. That's a recipe for disaster at Specialist Trading, because here is a clear-cut plan for entry that's based on what the market is telling you and not on what an outside source is telling you, such as a news event, such as too many indicators that you're following, or such as some trading room or chat room. We only really want to listen to the most important thing, and that's the market that is right in front of you. Okay, so how do we use this confirmation technique? Well, here are the rules, and once again, this is just a technique for entry. When I say rules here, it's an entry rule technique, but it is not a strategy. Okay, so I don't want you to think that, well, now I know how to trade this strategy. This is just something that you apply to a strategy. It's an extra component that you must apply to a strategy to give it that greater edge. So let's say you have a buy signal in your strategy, whatever it is. After you get that buy signal, rather than just purchasing at the market or buying with a limit order below the market, here's what you want to do. After an entry signal has been given, only buy once price trades 1 to 2 ticks above the original entry bar. Okay, that's it. And continue to track until you get long or until the signal is canceled. Let's say you get a sell signal. Regardless of what the strategy is, whether it's one of mine or whether it's something you've come up with or from another educator, rather than just simply selling at the market, we only want you to enter after an entry signal has been given. We only want you to sell once price trades 1 to 2 ticks below the original entry bar or the signal bar. Okay? Now let me show you what that means. I know that may be a little wordy and confusing, but let's look at an example here. These are just some educational examples. As you see here, regardless of what this is, this instrument is going up. It's in an uptrend, as we can see. And rather than just simply buying at the market, once we start to go into some type of pullback phase, simply put these little green bars here. This is where you would buy once it trades 1 tick above. So you simply wait to see if it trades 1 tick, and as long as the signal is still valid to go long, you continue to just monitor it and track it down, and then that's where you buy. That's your confirmation. You see, the market is telling you it's okay to get in now, not some outside source. So just simply listen to the market. It tells you everything you need to know. Same thing will work in a downtrend. We see here that we have a downtrend. Rather than simply jump in and sell, wait for price to stabilize and start to pull back, and this is where you apply the confirmation entry technique. Only enter once price trades 1 to 2 ticks below the previous bar's low. And once it trades there, that's your confirmation coming from the market that the trend has resumed lower. See, it's very similar to a train leaving a station. Let's say you are at a train station and you want to get from point A to point B, and you're waiting at the tracks, and you see a train coming down the station. Well, the train is coming down in your direction, but it's headed in the opposite direction of where you want to go. You're not going to jump on that train. Okay, but this is the way most traders trade. They want the market to go up, and they see it going down, so they buy. You're entering the market while it's going in the wrong direction. What you want to do is have confirmation that it's headed in your direction. And the way we get that confirmation is by seeing some type of a pullback and seeing price trade 1 tick below if we're going short, or 1 tick above if we're going higher. Okay, so that's our confirmation technique. Once again, where most of my beginning students have trouble with this is they feel that this is a strategy. You have to have other parts of the strategy in place, such as what composes an entry signal, where to place your stop, where to exit. And this is just a component that tells you how to fine-tune the entry. All right, so we've put the two edges together. We've explained what they are. These are the most powerful edges we have at Specialist Trading, and these two edges make up probably one of our most resilient strategies for trading the E-mini. That's strategy number 7. So let's talk a little bit about E-mini S&P strategy number 7. Okay, this is a pattern recognition strategy. So we're looking for a specific pattern that goes back anywhere from 1 to 5 bars previous to entry. So we're looking for that pattern. Once we find that pattern, which unfortunately is only privy to our members at this point, but once we find that pattern, which is very simple, then all we do is start to incorporate our edges, the confirmation and the buy-sell line. Now, the only indicator we're using, since this is a pattern recognition strategy, is our buy-sell line, the 50-period simple moving average. It doesn't get any simpler than that. But the beauty is, strategy number 7 trades virtually in any direction. You can go long, you can go short. It trades the E-minis or anything related to the main markets, such as the ETFs, such as the spiders or the diamonds or the QQQs, and even we don't have listed here, but the IWMs, that's the ETF on the Russell 2000. You can apply it to those as well. Now the trades last anywhere from 1 to 5 days or 1 trade per week. So the average trade lasts about 3 days roughly, and you're getting on average about 1 trade per week. Okay, so very simple, not something that's extremely intense where you have to be monitoring 24/7 all the time. It's not an intraday trading strategy. It only works on daily bars, okay? But extremely, extremely simple. As I said, you average about 1 trade a week, and the trades last anywhere from 1 to 5 days at most. So you see how simple and how basic this is. Now let's show you some of the results. We talked about the components that make up this strategy. Let's talk about some of the results. And we have to measure them against the S&P because obviously we're trading the E-mini, which is based off of the S&P. And if we look at how the E-mini performed in 2012, which was last year, we see that the E-mini was up a little over 13%, almost 13.5 at 13.4%. Okay? It's not bad. So if you're basing your IRA or your portfolio on the S&P and you match that, it's pretty good, 13.5%. Well, how did strategy number 7 perform last year, averaging roughly about 1 trade a week, holding on average about 3 days? And remember, these results are based off a $15,000 account, trading 1 contract per daily bar signal. But please remember that past performance is not indicative of future results. These examples are for educational purposes only. So we always urge our students to invest wisely. So how did the E-mini strategy 7 perform last year as opposed to the S&P? Well, it was up 63%. So roughly based on a very small $15,000 account, you could have had nearly $10,000 or roughly about $9,500 profit trading 1 contract. Now many of our members trade more than 1 contract. We have hedge funds users that trade this strategy. We also have just very new students who trade this strategy. So it's nothing that you have to be advanced in order to trade. All right, so how well has strategy 7 performed for the first 2 months of 2013? All right, in other words, even though it is the first week of March, we're just going to look at the first 2 months because we haven't had a signal yet as of March. Remember, these results are based once again on a $15,000 trading account, trading only 1 contract per daily bar signal. Okay, please remember that past performance is not indicative of future results. These examples are for educational purposes only, so always invest wisely. So how well have we performed for the first 2 months of 2013? Well, the account is up 20%, okay? 20% already just for the first 2 months of the year. I know a lot of people who have been trading this year have seen the market go straight up, but they haven't gotten involved because they don't trust it or don't believe it. They listen to economic indicators, or they're worried about what's going on with the economy or what's going on with the government, or they're in some trading room or chat room that says that you have to short this market, and they have nothing to show for it. All we've done is gotten in sync with our first 2 edges and had maybe 1 trade a week for the past 2 months, and our count is already up 20%. So let's look back at the first 2 months of 2013 and just show you where these signals were. I'm sorry we can't give away all the rules here, but we can go over the edges we talked about, and we can talk and show you how they were applied, and we can show you exactly which day these signals were generated. Now the first thing we want to do, looking back at a daily chart of the E-mini, is ask ourselves, where is price in relation to the buy-sell line? Okay, so I'm going to ask one last time, where is price in relation to the buy-sell line? Obviously, price has been above this entire time starting since January, so this means we were only looking for buy signals. So we weren't even considered going short the E-mini this entire time until we have some consecutive closes below this 50-period simple moving average. So it's that simple. So right off the bat, we know we're only looking for buy setups using strategy number 7. And so once the month of January started, we see here that we had a signal generated right here, which I believe was on the 7th of January. Now this was according to our proprietary pattern recognition strategy. We can't really give you the rules or divulge rules of that, but as you see on this day, the pattern came into fruition, and so we were basically going to apply our confirmation technique. Once the pattern solidified an entry, we simply said, well, we're not going to buy at the market, we're not going to place a limit order lower, we're simply going to wait to get confirmed that we go above the signal bar's high, which we did. Okay, and as you can see, the market went higher. Then later on, another pattern recognition entry signal was generated, so we simply waited, and we got long the next day as well. Later on in the month, at the very end of January, another signal was generated, so we entered the very next day and got long there as well. A day later, the first week of February, another signal was generated to go long, so we entered once again. 2 days later, another signal was generated, so we entered long once more, 1 to 2 ticks above the high of the signal bar. Later on in the month, in the middle month of February, we had another signal where we see we went long. Just a week or two ago, we had another signal to go long, and then lastly, this was just a week or two ago, we had our last signal to enter the very low of this pullback and met all the pattern recognition requirements, and so we entered to go long. Now I want to just go into detail about this last and final signal that we've had here. This was our 8th signal. As you can see, we had 8 winners in a row. We have a basic standard way to exit, which I can't get into right now, but I'll show you one of the trades, which is our last trade, and I'll show you the standard exit form for all these trades. But I want to go into detail about a news announcement that came out in the Los Angeles Times on the 5th of March, which was Tuesday of this past week. And after the close, this came out on the online edition. It said the Dow rockets to a record close. This was March 5th, right after the close of the market. It said the Dow Jones Industrial Average rose more than 100 points today, allowing the world's most watched stock index to close at a record high. It marks the highest daily close since October of 2007, just before the financial crisis punished the stock market. So a lot of people hearing this finally said, well, I guess it's time to get back in. We're making new highs. Everything is okay. And the thing that's interesting about this is that this was the day that we actually exited our trade. I know a lot of people pay attention to the news and use this once again to make their entry or exit decisions. We don't listen to news at specialist trading. We very rarely even concern ourselves. Remember, the most important thing you should be listening to is the market itself, the chart that's right in front of you, regardless of the time frame. So when this news came out, which was on the 5th, let me show you what we had issued a week earlier to all of our members. This is the email that goes out the night before when we get a signal, and if you're a member of Specialist Trading, you would receive this. On the 26th, we sent this out to all of our members that are Strategy Number 7 members and gave them an alert that Trading E-mini course members that Strategy Number 7 had generated a signal to go long the E-mini. We told them where to go long, where to place your entry, where to place your stop, and where to place your exit. And these were all the standard generic rules. There are a number of different ways to trade Strategy Number 7. If you want to trade it conservatively, aggressively, or if you want to even be ultra aggressive, we give you all the different options. But this is just the standard way to trade. Now, as we see here, excuse me, on the 26th, this was the night the signal was generated. So you would have known exactly that the pattern recognition had fallen into place looking back the last 3 to 5 bars. And so this was our entry bar right here. But once again, we do not simply buy at the market. We have to wait for the market to give us confirmation. So this meant that the next day we would purchase the E-mini if it traded 1 or 2 ticks above the signal bar's high. Well, the very next day, as you can see, it did trade above there. So all of our members went along, and guess what? 5 days later, you could have used the standard exit, which would have been the day that the market made new highs. That's the day we actually got out, with a over 34-point gain in the E-mini in just 5 days. Okay, it's over $1,700. So trading one contract. Now this is how simple it is and how basic it is. There are other ways to trade it as well. There are more conservative ways to trade it if you'd like to get out quicker and just take a quick profit. But we show you all of this in the course and in the class on how to trade this. Once again, We are listening to the most important thing there is, which is the market. When I first started trading, I took all my cues from news announcements, from the earnings reports, from the trading rooms I was involved in, and I really didn't have anything to show for it. It wasn't until my mentors taught me how to listen to the charts in front of me, without a lot of indicators, without a lot of tools, that trading started to become consistent. Okay, so let's talk about Emini strategy number 7. It's designed to be as simple as possible, as you just saw. The strategy has probably no more than 5 rules, I believe, altogether. This is including the entry, stop loss, and exit points. It's extremely consistent, as you just saw. The last 8 trades we've had, one per week for the last 2 months, have all been winners, generating winners. Whether you wanted to trade it conservatively or aggressively, they were all winners. Our account, by the way, going back the last 2 years, is making all-time highs. On a $15,000 account, I believe the account now is roughly at about $33,000. And also, it makes you a part of the process. Okay, this once again, by giving you all the different options and ways in which to trade it, you're still using the foundation of strategy number 7, but you are a part of the process. You're simply not taking your clue as to what to do from some blind indicator or from some notice that comes out at night. You really understand all of the rules so that ultimately you won't need to see that email telling you that a signal has been generated. You'll know right off the bat that you have a buy signal in strategy number 7. Remember, simplicity equals consistency. Once you strip away what my mentors call the useless noise that most traders rely on, and you make your trading simple, that's when you'll get on that road to consistency. So we're not trying to promote hitting home runs. Every now and then you will have a home run, such as the last trade we saw here with the strategy number 7. But what we're really looking for is that 2 steps forward, 1 step back. Remember, we want you to be trading 10, 20, 30 years down the road. My goal is to teach you the same thing that my mentors taught me, which is how to trade with the specialist edge, which is ultimately just the foundation, which is the format of simplicity in everything that we do. Okay, so let's review. What did we give you today? We gave you 2 great edges, the most powerful edges we have at specialist trading, usually reserved for our members. We gave you the buy-sell line, which is the 50-period simple moving average. So once you plot that, you have to ask yourselves, before you buy or sell, I don't care how convinced you are, how well you should take the signal, ask yourselves, where is price in relation to that buy-sell line? If you get a buy signal and it's above, that's great. Go ahead and take the signal. If your signal is below and you get a buy signal, I would strongly recommend not taking the trade, because over time, it's a numbers game, but over time you will not be consistent with your trading. Okay, then we gave you edge number 2, which is our confirmation method. It is simply a way to fine-tune your entry. If you get a buy signal, regardless of whatever strategy you are using, only buy once price trades 1 to 2 ticks above the previous bar's high. Only sell if you get a sell signal once price trades 1 to 2 ticks below the previous bar's low. As you see, we use both of these great edges to format probably our most resilient strategy for trading the E-mini. That's strategy number 7. Now ask yourself, in closing here, do you think any of these edges, the 2 I just described for you, the 2 that make up strategy number 7, do you think using any of these edges this past year could have helped your trading? All right, I mean, think of it. Think of all your signals that you had, all of your trades, whether you're an investor or a day trader or an intraday trader, doesn't matter. Just go back and think and see if it could have helped your trading. And if you're having trouble trying to figure out if it would have helped you or not, here's a homework assignment for you, right? I bet you didn't think you were going to get a homework assignment coming to this presentation. But simply go and look at your past 10 or 20 trades and plot a buy-sell line, 50-period simple moving average, and then apply the confirmation technique, all right, the confirmation method, and see if they could have helped your trading. I really strongly believe that, sincerely, they could have helped your trading and put you into that, hopefully, in that direction where you become a member of that 5% club that is able to consistently generate profits. Now, for the last couple of minutes here, I'd like to just take a second to invite you all to become members of Specialist Trading and to become members of our Strategy Number 7 course. This is the course we just talked about. Those are the last 8 signals we just had that has the great results. Now, this strategy is really probably our best E-mini strategy we have out of all the strategies we trade for trading the E-mini overnight. Now, even at the regular price of $14.95, it's a tremendous steal. As you saw in those last 8 trades, you could have paid for, with that price, you could have paid for many times over just using that. But we've even discounted the price more down to $12.95 for the attendees today. This is for a limited time only, so if you're really interested in getting a strategy that incorporates these 2 techniques, these 2 edges we talked about today, and one that is very extremely consistent, that you can rely on, that will sustain you, I strongly suggest taking advantage of this discount we have. As you can see, you'll become a member and you have instant online access. You don't have to wait. You'll be knowing the rules as early as tonight if you'd like. You saw how much attention I give to instruction. You'll get more detailed instruction within the online video courses where I teach you all the entries, all the exits, and all the stops. I teach you how to trade it aggressively or conservatively. And remember, we furnish you with 1-year trade signal alerts just so that you can check your work, so that you know that if you see a signal, you'll know that if you get an email that you were in line with the signal and you're learning how to spot them. But after, I can almost guarantee that after a couple of months, after you learn how to, the rules behind the strategy, you'll be able to spot them on your own and you won't have to rely, on a signal alert at all. We also provide you with 1 year of weekly trading lessons, 1 year of videos that I provide for you so that you can even heighten your trading even more. And then lastly, you have personal email access with myself. You'll get my personal email address so you can contact me whenever you'd like. If you have a particular question, don't understand why we went long or why we went short, or don't understand the process altogether, you can email me whenever you'd like and I'll answer any question. Remember, this is a ridiculously low price at $14.95. The last 2 months you could have bought a couple of these programs at that price. We're reducing it even more down to $12.95. And please remember that this price is going to be going up, I believe, closer to $2,000 within the next couple of months. We're raising it because the strategy is just too it's just too valuable. It's performing too well, and it's just too inexpensive at these prices. Once again, on a $15,000 account, going back 2 years, your account would be over $30,000 right now. I believe closer to $33,000. So that's just trading the standard, most basic way to trade the strategy number 7. And these are all real-world signals that we provided with our members. These are not. This is not hypothetical. These are all real-world signals that our members have been taking in strategy number 7 for the last 2 years. That's why we really strongly believe that we're going to raise the price closer to $2,000 or maybe even higher going in the few months to come later on down the road. Now, as promised, if you have any questions, now's the time to ask. If you'd like to learn more about our individual strategies, you can go to our sister site, which is protraderstrategies.com. Once you go there, you'll see a number of our strategies. You'll also see a way in which to purchase strategy number 7 with that discount. Now, if you have any questions, you can contact our head of sales, which is Don Jans. He's at donjans@protraderstrategies.com. You can send him an email, and he'll answer any questions that you may have. Or also you can call us directly at area code 310-844-7220, and you can speak to us and we'll answer any question that you may have or hold that discount for you if you're very serious about becoming a member of Specialist Trading. Now, let me just see here while I have you. If you have any questions, I see there are a number of them, and I want to thank you all for waiting. I know many of you like to ask questions while the presentation is underway, so I thank you firstly for waiting. Okay, let's see some of the questions. Frank asks, are you going to share the strategy with us today or just the performance results? Well, Frank, I can't share the strategy. I gave you the 2 components, the main components, but that wouldn't be fair for the members who have paid up to $1,500 to know the rules. So I'm sharing with you the performance results, as the title states, the performance strategy results, but in order to become to know all the rules, you must become a member. It's not fair to all the people that have paid that amount that know all the rules. Okay, it's too valuable to give away for free. Let's see, another signal. The signal that you showed to go long on the 21st surely would have been a loss unless you trade without stop losses. Thank you. No, actually, all of these trades were winners. I don't want to give away the rules, but all these trades were actually winners. We have not had a loss within the last 2 months. And at the very worst, if you traded it the most conservative way and you didn't want to take any of the exits that we gave you, you would have broken even on the trade. So we teach you all of these different things. I think you're trying to, Frank, you're trying to come up with an exit scenario, but no, they were actually winners looking back. Can strategy 7 be used for stocks also or only E-minis? Mark, that's a very good question. Yes, it can be used for stocks, but we don't have any data or any signals that can give you any reference to that. I know that it's a standard pattern recognition strategy that will virtually work on anything, but I've seen that it works the best on the E-minis on daily bars. Okay, we don't apply this to intraday trading E-minis, but I have seen it work on the spiders and the IWM and the QQQ. So if it works on those ETFs, I'm sure it will work on stocks as well. Yes, we just don't have any. I don't want to promise anything because we don't have any reference for that. But it's not as if we're using some far-out indicator that is only akin to the E-mini. It's not just that. We've just seen that it works extremely well. Okay, that's a good question. I was also told to use the exponential moving average versus the simple. What is your view on using the EMA versus the SMA? Alex, that's a good question. I was taught to use the simple. Now, I know a lot of traders like to use the exponential, but when it comes down to it, it really isn't that much of a difference. It's in detail. It really doesn't matter. What we're looking for is that you are in sync with the market. And the best way to be in sync is to see price above that moving average. Now, I know a lot of traders like to use exponential. I know a lot of traders like to use a 200-day moving average. Some traders like to use a 20. That's okay. They're all fine. But we found out since I've been working on the floor and through my history of trading, that for all markets, different time frames, the 50-period simple moving average seems to work the best. It transfers over easily and the best onto all markets. So that's why we subscribe to that. But there would be nothing wrong with wanting to use an exponential. I would just stick with the 50-day though, okay? Because it transfers over really easily onto whether you're looking at a daily bar, a monthly bar, or a 5-minute bar, or a tick bar chart. It doesn't really matter. But an exponential would be fine just as long, once again, as if the majority of price is above, you'll only be looking for buy signals, okay? And then vice versa. Alex also asked, what is the value of one tick in your example? Well, one tick would be roughly, if you're looking at the E-mini, it would be 25 cents. In other words, each point for the E-mini has 4 ticks, and they're 25 cents. So, every increment of 25 cents is a tick. If you go up 50 cents, that's 2 ticks. 75 cents or 3/4 of a point is 3 ticks, and so on. Okay, so that's how it works on the E-mini. Now, if you're looking at a stock, obviously a tick would be the value of 1 cent. Okay. If you're looking at the Forex markets, it would be roughly 1 or 2 pips. Okay, I hope that answers your question. Is the E-mini a future strategy? Yes, it is. Basically, the E-mini is a future. It's the future based off of the S&P 500. So yes, it is. But once again, it works off. You can still apply this to the mini Russell futures. You can apply this to ETFs as well. Okay, anything that is based off of market indices, it works extremely well. But as that gentleman asked before, I believe Mark asked, will it work on stocks? Yes, it will. I just don't have any type of stats or any type of reference to show you how well it works, as opposed to the E-mini, where we do have roughly 2.5 years of reference going back on the E-mini. Okay, let's see. Let me see. If you don't watch the news, then would you say you consider yourself primarily a technical trader? I guess so, but you know what? I only, at the very most, use one indicator. So maybe I would say 2, because many times I don't even count the buy-sell line as an indicator. It's going to be on every chart I have. So basically, all you're really going to be looking at is just either the buy-sell line and one indicator, or just the buy-sell line by itself and then some pattern. It's extremely simple. As I stated, when I first started trading, I had maybe 10 or 15 indicators on my screen. I was looking at every news source. I was looking at every type of statistical nature that would come out, or something referencing the earnings reports. I was involved. We didn't have chat rooms or trading rooms at the time, but we subscribed to newsletters, and I had tons of those. And I got all my signals from those things, and I couldn't make a dime. And that's the thing. When my mentors taught me to strip away all those things, and I started, maybe only using one indicator. I forgot about the news, and I really didn't rely on outside sources. That's when trading starts to become consistent. So that's what I want to teach you, just not to rely so much on these things. Because if you look at all traders, they all have their own edges, or what they believe are edges, and they all rely on these outside things. And then once they rely on them, they see that they're no further closer to becoming successful than they are if they didn't use them. So why not strip them away and see how well you can do without them? And we have the actual numbers here. We have all of our members are happy. I know a lot of you may be wondering, well, how do we know that this is real? How do we know it works? As I often tell the naysayers, the people that are frightened, they're scared of getting hurt, do a Google search on us. And for those people who are really fraudulent or trying to just basically sell things that don't work, you'll see a number of people responding saying not to waste your money on these things. But I don't think you'll find that if you do a search on us. I think you'll see a lot of satisfied customers. You'll see real-world results and people that are happy and not any complaints at all. So that's really, the proof is in the pudding. I know a lot of people are scared, and if you're scared, that's great. And in fact, I believe if you're scared, you probably should not be trading. So I know there are a number of people that are frightened, and it's best probably to stay at the market, out of the market, because that's not a way to be trading. That's not a good way to start anything. Okay, so we want you to trust in us. So do a search on us, and we showed you the results here, the actual proof of actual real-world signals, and gave you two great things that you can start using as early as tomorrow. So usually our members pay for these things. We've given you these two edges for free. So I don't know of a lot of educators that give you that much information and things for free in good faith. And so really, as I stated, our goal is to teach you how to trade with the edge. Our goal is not to just generate signals and pass them on to you without you understanding the process. Okay. Alex says, if you don't watch the news, then would you say you consider yourself primary technical? Oh, I'm sorry, I'm reading the same question. Yeah, I guess so, but once again, many times I don't even use an indicator, so I don't know what I would be. I think I would just basically just be a chart reader. I think more than anything else, I'd just be a chart reader. Once again, let's just go over these addresses here and the phone numbers. If you're very interested and you want to become a member, I really strongly suggest that you take advantage of these sales, because not only are we dropping the price for the next few days for the members that attended today, but also at the same time, and this is not in any way a way of trying to frighten you or dissuade you, but most likely because this performed so well, we were going to be raising the price. So we'd love for you as our members, as our people that are already currently members or people that are seeing for the first time, to take advantage of this great price. So if you can, and you want to ask us any questions, you can call 310-844-7220, or you can contact Don Jans. He's our senior sales rep, Don Jans at ProTraderStrategies.com. I thank you so much for attending. We try to give you these free educational webinars once or twice a month, and each webinar we give you something free to use so that you can really go away and use them the next day, such as we did today. We gave you two free things, so I hope you can use them and really help elevate your trading. Even if you decide not to become a member, I think that these two things we gave you today will help your trading tremendously, okay? So it just shows you where we're coming from. Thank you so much for attending. Hope you become a member of Specialist Trading, and we'll see you next time. All right? Bye-bye.